Why is China willing to pay a massive 13% tax premium just to vacuum up every single silver bar on the market, while the West is still obsessively distracted by gold? Is this a catastrophic investment blunder or a masterstroke, a strategic chess move designed to checkmate the old financial system? Right now, something unprecedented is happening under our noses. While mainstream media focuses on the S&P 500 or the latest Fed meeting, a silent currency war is brewing in the precious metals market. If you look at the price of silver in London or New York today, you'll see one number. But look at the Shanghai Gold Exchange and you'll see silver trading at a massive premium, sometimes $6 to $10 higher per ounce. China isn't just buying, they are aggressively draining the world's silver reserves. They are absorbing hundreds of tons every single month, ignoring the extra costs, ignoring the taxes, and ignoring the traditional rules of Western trading. Today, we are going to dive deep into the winners and losers of this global shift. We'll decode the hidden arbitrage gap between East and West and reveal why silver has quietly transformed from a simple precious metal into the most critical industrial weapon of the digital age. By the end of this video, you'll understand why the experts calling for $370 silver might not be crazy. They might just be the only ones paying attention. Let's get into the data. To understand why silver is vanishing from London's vaults, we need to look at the screaming numbers coming out of the Shanghai market. Think about this. In the world of finance, there is a concept called arbitrage. In simple terms, it's buying something low in one place and selling it high in another. Usually, in a globalized world, price gaps between London and Shanghai are tiny, just pennies. But recently, those gaps haven't just opened, they've exploded. As James Anderson recently highlighted, China has been absorbing over 800 tons of silver in a single month. To put that in perspective, that's 2 to 3 times their regular flow. Why? Because the price on the Shanghai Gold Exchange is significantly higher than the COMEX in New York or the LBMA in London. Now, you might ask, if it's more expensive in China, why buy it there? The answer is simple. Demand is so high in the East that they are literally pulling the metal out of Western vaults. This isn't just paper trading, this is physical bars of silver being loaded onto ships and planes. But here is where it gets technical and very interesting. We're seeing a phenomenon called backwardation. In a normal market, the price for silver delivered a year from now should be higher than the price today. Why? Because you have to pay for storage, insurance, and the cost of money. That's called contango. But right now, we're seeing the opposite. The price for immediate physical delivery is spiking above the future price. This is the market's way of screaming, we need silver and we need it right now. When you see backwardation in a commodity like silver, it's a massive red flag for supply. It means the warehouses are getting empty. It means the big industrial players are worried they won't have enough metal to keep their factories running next month. London's silver stocks are currently sitting at historical lows. The COMEX is seeing consistent drawdowns. And where is all that metal going? It's following the money. It's moving to where the premium is highest. It's moving east. This isn't just a momentum trade or a group of Redditors trying to squeeze a hedge fund. This is a fundamental structural shift in how the world's silver is distributed. China is essentially taxing the world's supply to ensure their own industrial survival. They are paying the premium because they know something the average Western investor hasn't realized yet. And this leads us to a much bigger question. If China isn't just buying silver for value, what exactly are they using it for that makes it so urgent? The answer lies in a sector that is currently exploding, and it's not just about jewelry or wealth preservation. It's about the very technology you're using to watch this video right now.
But if you think China is buying silver just to store value like gold, you are dead wrong. They aren't just stacking bars in a vault. They are buying the nervous system of the 21st century. Here is the twist. Silver has quietly transitioned from a precious metal to a strategic geopolitical weapon. Why? Because you cannot build a high-tech future without it. Period. Let's look at the dominance of the dragon. Currently, China controls over 80% of the world's solar panel supply chain. This is massive. Every single solar cell requires silver paste to conduct electricity. Silver is the most electrically conductive metal on the periodic table. There is no cheaper, scalable substitute. As the world pushes for a green revolution, China has realized that whoever controls the silver controls the energy of the future. But it's not just about solar panels. Let's talk about the elephant in the room: artificial intelligence. We're in the middle of the greatest computing boom in human history. Every AI server, every high-end GPU from companies like NVIDIA, and every robotic sensor requires high-purity silver for its circuitry. AI chips need to process data at lightning speeds with zero tolerance for heat-related resistance. Silver is the only metal that can handle that kind of load efficiently. Think about the irony here. The West is obsessed with paper AI, trading tech stocks on the NASDAQ, while China is focused on physical AI, hoarding the actual physical material required to build the hardware. They aren't just betting on the price of silver to go up, they are buying control over the future of green tech and robotics. In the geopolitical arena, this is what we call a bottleneck strategy. If China continues to drain the Western silver warehouses at the current rate, the US and Europe might find themselves in a position where they have the software, but they don't have the guts to build the machines. I want you to really grasp the scale of this. Most people see silver as a poor man's gold. That is an outdated 20th century mindset. In 2026, silver is the new oil. And just like oil in the 1970s, the supply is concentrated, the demand is inelastic, and the geopolitical tension is rising. If you look at a Tesla bot or a sophisticated drone, you're looking at ounces of silver moving through its veins. If silver supply gets choked off, the AI revolution hits a brick wall. This is why the 13% tax premium I mentioned earlier doesn't scare the Chinese manufacturers. They aren't speculators, they are survivalists. They know that in a world of trade wars and supply chain de-risking, having physical silver in your possession is the ultimate form of power. So we have a massive arbitrage gap, and we have a life-or-death industrial need. But there's a third factor that makes this situation even more explosive. You see, while demand is skyrocketing, the faucet of global silver production is starting to run dry. And when you see what's happening at the mines in Mexico and Peru, you'll realize that $370 silver isn't just a bold prediction, it might be a mathematical inevitability. We've talked about China's aggressive hoarding and the high-tech arms race, but there's a massive problem, one that the paper markets in Chicago and London are trying desperately to ignore. The faucet of global silver production is physically running dry. According to the latest data from the Silver Institute, we are currently in our 5th consecutive year of a structural deficit. This isn't just a minor shortage, it's a fundamental gap where the world is consuming hundreds of millions of ounces more than it's mining. Look at the giants of production, Mexico and Peru. These regions are facing a dead end. Between rising energy costs, depleting ore grades, and increasing environmental regulations, mining more silver isn't as simple as just flipping a switch. In fact, experts estimate it takes an average of 10 years to bring a new silver mine from discovery to production.
Think about that timeline. The AI revolution exploded in just 2 years. The solar boom doubled in 3. We're using 21st century technology at a 22nd century pace, but we are relying on a 20th century mining infrastructure. That gap? That's where the perfect storm happens. This is why the math behind $370 silver isn't just a clickbait number. It's based on historical reality. Let's look at the S&P 500 to silver ratio. As James Anderson pointed out, It currently takes about 100 ounces of silver to buy the S&P 500 index. But historically, when the market corrects and silver enters a true bull run, that ratio has collapsed to 20 to 1. If we do the math based on today's stock market valuations, for that 20 to 1 ratio to repeat itself, silver wouldn't just hit $50 or $100. It would need to skyrocket toward $370 an ounce. Now, I know what you're thinking. That sounds impossible. But remember, silver is a tiny market. It's a fraction of the size of the gold market and a microscopic speck compared to the global stock market. When big money decides to rotate out of overvalued tech stocks and into the one material that those tech stocks actually need to exist, the price move won't be a staircase, it will be a vertical elevator. We are looking at a situation where physical reality is finally catching up to financial fantasy. You can print trillion-dollar stimulus checks and you can inflate the price of digital assets, but you cannot print an ounce of silver. You have to find it, mine it, and refine it. The Western world is currently asleep at the wheel, treating silver like a discarded relic of the past. Meanwhile, the East is treating it like the precious fuel of the future. The warehouses are draining, the mines are struggling, and the demand is just getting started. So the real question isn't whether silver is going higher. The real question is who will be left holding the bag when the West realizes there's nothing left in the vaults. Everything we've discussed today leads to one undeniable conclusion. The game has changed. We are no longer just looking at a simple fluctuation in precious metals prices. We are witnessing a fundamental shift in global power. China is playing the long game. By aggressively draining Western vaults and ignoring short-term premiums, they are securing their position as the gatekeepers of the 21st century's most vital resource. They've realized that silver is the new oil, the indispensable fuel for the AI revolution, the green energy transition, and the future of robotics. While most retail investors are still focused on preserving what they have, the biggest players on the world stage are focused on possessing what the world needs. The structural deficit is real, the arbitrage gap is real, and the mathematical road to $370 silver is paved with the physical reality of empty warehouses and exhausted mines. We are moving from an era of paper wealth to an era of strategic assets. So here is the question you need to ask yourself. If silver truly becomes a controlled strategic material, much like oil was in the 20th century, do you want to be the one who owns it or the one who has to pay an astronomical price just to use it? History doesn't always repeat, but it often rhymes. And right now, the rhythm is pointing toward a massive revaluation of the silver in your hand. What about you? How are you balancing your portfolio between gold and silver right now? Are you following the smart money to the east, or are you waiting for the west to wake up? Share your strategy in the comments below. I read every single one, and I'll be there to discuss it with you. Thank you for watching, and I'll see you in the next analysis.